I'm going to be talking about fringe benefits and taxability. So while Tim said that OBBBA was the only hot topic, I guess he's dethroned me in this topic. But we do have just a little shorter version of it because we do go over this each year and not much has changed. So let's get into fringe benefits and their taxability. So let's start with what is a fringe benefit. Fringe benefit is a form of pay in addition to an employee's basic wage. So usually that is any type of property, services, cash, or cash equivalents. Fringe benefits are taxable unless it is excludable under IRS code. Taxable means that they are subject to federal and state income taxes as well as Social Security and Medicare. So I like to start with, what you can exclude as opposed to what you can't exclude. So de minimis fringe benefits. What is a de minimis fringe benefit? Well, those are things that are small in amount and value and not easy to account for and given infrequently to employees. But the $1 million question is, how much is de minimis? What is that threshold? So I feel like we talk about that every year, and unfortunately, as the IRS tends to do in many cases, they do not give direction on that. However, there has been a case, a specific case that went through the IRS in which they did rule that something over $100 is not de minimis. So some people choose to use that rule of thumb, but it's always best to, if you can account for it and it's not impractical to account for it, then you would account for it, but you also want to document if you feel that you can't it's not, that you feel this is de minimis, even though maybe someone else may not feel it is. Another excludable benefit are achievement awards, so length of service awards, as long as they are non-cash. However, there are criteria that must be in effect in order for these to be considered excludable from benefits. So the employee must have had at least 5 or has worked for the company for at least 5 years, as well as has not had an award within the last 5 years. Additionally, it is limited to $400 in value per employee under a non-qualified plan. There is another limit if you have a qualified plan, which simply means that you have a written policy document of this program, and that limit is $1,600 a year. And then last but not least, this is not disguised as a method of pay. So why do I say non-cash? So I'm pretty sure everybody in this room knows this, but if it were a cash achievement award, it would be taxable. So that takes us into cash. Cash is always taxable. No matter how small the amount is, it's taxable. It can never be considered de minimis. That is cash, that is gift cards, that is cash equivalents, gift certificates. My client gives out turkey gift certificates to one of the collective bargaining units. That's taxable. We added it as a fringe benefit to those employees' paychecks so that it is taxed. And it's only $15, but it's taxable. So let's get into some other taxable benefits that a lot of people in the room may offer to their employees. We're going to go over car allowances, employee-provided vehicles, uniforms, non-additional cost services, wellness programs, and employee reimbursements. So some employers provide a car allowance. They do it maybe for different reasons. Maybe it's just additional pay that they give to that they offer to certain employees. Maybe those employees travel a lot to meetings, so as opposed to doing mileage reimbursements all the time, maybe they choose to give the employees a car allowance. Those car allowances are taxable. Essentially, they are additional income. However, they are not subject to IMRF if the employer has a board-approved resolution on file with IMRF that allows the taxable fringe benefits to be excluded. Note that if you did not have that on file prior to August 2017, you can no longer file that resolution with IMRF. So what if your employer allows employees to take home vehicles? So there are different ways to calculate the taxability of that, but it is taxable unless it falls within one of these exceptions. If it is a clearly marked police or fire vehicle, or it is an unmarked vehicle used by a law enforcement officer that is authorized to carry a firearm, execute search warrants, and make arrests, then it would not be a taxable fringe benefit. There are 3 ways to calculate it. There's the automobile lease value, the commuting rule, and the cents per mile rule. The IRS gives details about when to use what, when it is appropriate to use which one, as well as if you want to change the way you are valuing it, when you can change. So there's more information about that in Pub 15B, and at the end of this presentation, we have a list of resources for you as it relates to fringe benefits. Next one we'll go through is uniforms. So with uniforms, essentially uniforms are not taxable if all of the following are in play. If it is paid under an accountable plan, so once again, an accountable plan is a written plan that you have in place explaining the reimbursement of it, and they have to be substantiated with receipts, the reimbursement. If it is clothing that must be worn as a condition of employment, and clothing that is not suitable to wear for everyday wear. Clothing worn by plainclothes officers is taxable. So if you have detectives or something like that, or other employees in your organizations that wear plainclothes and get a reimbursement for that, that is a taxable reimbursement. However, something that comes up a lot is like, well, what if it's a t-shirt that has the park district on there or the village name on there, and it's bright yellow? It's taxable. Like, they still could wear that out. Maybe they don't want to. Maybe you don't want them to, because you don't want them at all the different places they may go outside of work advertising your community or your organization, but that would be taxable. If you hand out a payroll to your summer employees or something like that, those are taxable fringe benefits. Safety boots are not taxable if it is paid under accountable plan, which means if they turn in receipts to substantiate the value that you're reimbursing, it would not be taxable. So no additional cost services. What are these? These are essentially services that are excess capacity services. So if you operate a golf course or a fitness facility and you allow your employees to utilize those facilities or those services, it may be excludable as a taxable fringe benefit. So there are 2 conditions that must apply for that. The service that you're offering must be offered to customers in your ordinary course of business, and the employer must not incur any additional costs or forego revenue to provide the service to employees. So that's a lot of IRS jargon, so what does that mean? Okay, you're running the golf course, and the purpose of your business is to operate a golf course for customers, not for employees, or a fitness club for customers, not for employees. As far as no additional, you don't incur any additional costs or foregone revenue. We always like to use the example of golf. I'm not a golfer, but if you have a golf course and you allow employees to utilize the golf course for free, and they are allowed to reserve whatever tee time they want, meaning maybe they do book the prime tee times that are usually higher priced for a paying customer, that would not be excludable because you are foregoing revenue to allow the employee to utilize that service. Another example that the IRS gives that I thought was a really good example, because maybe we've seen this happen but we don't think about how it all shakes out or the taxability of it, is an airline. If an airline allows their employees to fly for free, if the employee flies for free, like standby, like, oh, let's see if there's seats available on that airline, that would not be a taxable fringe benefit to that employee. However, if the employee is allowed to reserve a seat on the plane whenever they want to for free, that will be taxable because a customer could have booked that flight and paid. Wellness programs. So wellness programs, how many of you in this room offer a wellness program to your employees? I see quite a bit of hands. So I like wellness programs. They're nice. You do different things and you know, earn points or whatever your structure is. I know my client offers a wellness program that's actually available to employees and contractors, and they have a lot of contractors. And it's a tier program where you earn points by doing different activities, participating in events and such, and depending on how many points you get a cash benefit. Well, we all know that's taxable because it's a cash benefit. However, in many cases, wellness programs may offer other things like reduced health insurance, or maybe you get a gym membership or something like that, different benefits that may not actually look like cash. Well, I like to think of this wellness program incentive as one of those things that falls under what I said under the first slide. Unless the IRS specifically excludes this and says that it's not taxable, it's taxable. And if you go to Pub 15B, where they talk about fringe benefits, wellness is not anywhere in that document. So wellness programs generally are taxable unless the benefit that the person is or your employees are receiving is specifically excluded under IRS code. I feel like I've gone through this a lot, so I go through it pretty quickly, but that leaves room for questions for everything else that people want. So the last one that I'm going over today is employee reimbursements. Employee reimbursements can be reimbursed through payroll or AP, and I think that in many cases people do AP, but some employee reimbursements are taxable. Non-taxable reimbursements must have an accountable plan, meaning they need to be substantiated by receipts unless it is, unless you are utilizing like per diem rates for the federal government, for mileage. It must be a business-related expense. As I said, documentation. So adequate documentation, meaning that the date, the time, the business reason why this was there. So one thing that I see a lot with reimbursements, say for conferences, is that someone may submit a reimbursement and they say they went somewhere, but my question is always, well, where's the documentation that this actually happened? Like, was there actually a conference on May 15th, you know? So we ask that people turn in brochures or some type of certificate of completion, if that's provided, for those trainings to help beef up that documentation that this was in fact a business expense. And then advances. So some employers may offer their employees advances because maybe, you know, the employee doesn't have the funds or doesn't want to use their funds for a business expense and then wait until the event happens and AP run or payroll run to get reimbursed. So if an advance is provided to the employee, when you give that money to the employee, it is not a taxable benefit, but if they do not substantiate what those funds were spent on and or return those funds in a reasonable amount of time, then it would be a taxable fringe benefit. What's a reasonable amount of time? Well, you would determine that, but I would think you want it to be as, you know, as close to as the person could be after the event. So I would say somewhere between 30 and 60 days outside of the event, but that should be documented in your, perhaps your travel and training policy if you have one, or wherever that would go within your community's policy, so that employees know, well, if I'm advanced $500 because I had to buy a plane ticket or book a hotel room or something like that, they know that, well, right after that event, so many days after that event, I have to turn stuff in because I'm sure they don't want to be taxed for something that they did on behalf of the community, their employer. Some things that are taxable, as I said, unsubstantiated expenses. If you don't turn in those receipts, or if you submit a reimbursement without receipts, that would be a taxable reimbursement. If you do same-day travel expenses, so this one was one that that I actually didn't know about until about 9 years ago. But basically, if someone goes to a training and you reimburse them for their lunch that they bought that day while at training, that reimbursement is taxable. Their mileage, as long as it's at the per diem rate and not above it, would not be. But anything that you reimburse them for same-day travel would be taxable, even if they give receipts. Same-day travel it's called out in the IRS code that that's taxable. Overnight travel is not, as long as it's substantiated with receipts. And as I mentioned, per diem mileage, if it's over the federal per diem rate. So if you were to be audited by the IRS, you always want to be courteous, kind, and respond timely. You want to make sure you have all your ducks in a row. Make sure you have all the documentation prepared before they get there, and that it's organized so that you can get them out the door as quick as possible. I think that's kind of our rule of thumb with any auditor, whether it's IRS, IMRF, anybody. Let's get them what they need, and let's get them out the door. And always remember that you get more, you catch more flies with honey. So as I promised, we do have a list, and as Tim said, this presentation is going to go out after today, and with answers to any questions that may come up. But there are several documents out there. One thing that's nice when you go to these IRS documents is that they tell you right there on the front page what's changed. So like when you go to Pub 15B, it says what's changed in 2026. The only thing that has really changed is the mileage rate. So that's going up for 2026. But that's nice because the document, as many of you probably know, is a very long document. So if you had to scroll through there, or you can throw it in Adobe to compare the documents, but nobody wants to do that. It's nice that they tell you right off the bat what's changed or not. Several guides out there. I know the 1537 Fringe benefit guide, that's one that is specifically for government, so it's a pretty big document, and I know that one hasn't changed since 2022. So with that, I will take any questions you all might have. And there are hands. I'll start right here. So if the employer, so I know that there are different rules. I would have to look up the specific rules, but I do know that the limit is $5,250 a year, but I think that there may be a different limit if it's specific to, if there's some conditions where I think there's a different limit. So, but I would, you know that, Jim? Okay.
Here he comes.
Sorry, you get me again. And I only step up here because a member of our HR team and I just looked at this yesterday. So it happens to be fresh. Now, I'm not an expert on this part either, but the $5,250 is the dollar amount limit, but you have to have an educational assistance plan in place. There's some criteria that the IRS sets forth in Publication 15B for that EAP. And I don't know what they all are, but check. It's just a quick bullet point. I think it's 4 criteria, and if your plan meets those criteria, then up to $5,250 of educational reimbursements are excludable from income. But if you don't have a plan or you go beyond that limit, then it's taxable to the employee. Good?
So another question. Yep.
So if we chose to use some of that money to do like giveaways and give like raffles, since it wasn't like our money, it was donated, does that still have to be taxed, or?
If it's cash, it's taxable. It doesn't matter, I think, where it came from. Kind of like the wellness program. If you have a third party that's issuing payments to your employees, that would still be taxable. Now, if you took what they gave you and threw the party or bought something that's benefiting everybody, that would not be taxable. But if they gave you a stack of gift cards and you're handing those out to people, that's...
If you use that money to buy the food that everybody has at the park, then that's fine.
Correct, that's fine. Yep. So around the holidays, I think a lot of vendors drop off stuff, and we always share it amongst everybody. We haven't gotten any gift cards, but I have had a time in the past where someone dropped off like a Starbucks gift card, and it's like, well, no, you did great service, here's a Starbucks. Nope, this person would hand it over, and we go buy coffee from Starbucks for everybody, So that's how that works. Over here. That's up to your policy as far as if you reimburse for tax. So, speaking of that though, one thing that I've seen come up, and like I said, it's based on your policy, is that I've seen where some employers don't reimburse tax to their employees, even if it's, I went and bought donuts or something for the office and they say, we're not reimbursing tax. I have found, and I don't know if it's always been this way, that a lot of vendors don't allow employees to utilize the tax exempt certificate if they're not paying with the tax exempt entity's form of payment. So if you're not using a Village credit card that says, whatever entity that is on that tax exempt, that vendor may not allow them to, may not exclude it from tax. So I would say just be mindful of that, that if they're using their own personal payment, the vendor may not allow that.
I have a question about wellness programs. We have a program through Taxability where you can get points for doing certain things, and then you can get things like, not cash, but little goodies or whatever. Are those then taxable? So, like, we've had people purchase some. It was a site for, and he got that through his points. So, do we need to then figure out the value of the site for rental, or how do we?
I think that, so is this the Blue Cross Blue Shield program that's available to everybody who has
Yes.
Blue Cross
Yeah.
Blue Shield?
Yes, it
I
is.
don't think that you would,
Okay.
because I don't think that's not that's not a wellness program that you're offering. It's like, yeah.
Okay.
Yep. You agree, Tim? Any other questions?
For the same-day meals that you were talking about, is it the employer's responsibility to let the employee know that it's a fringe benefit and they need to claim that, or what onus falls on the employer?
So how we do it, so I've worked for an employer that doesn't offer that. Like essentially their reimbursement program does not offer a reimbursement for anything that would be taxable, and then they run everything through AP because nothing's taxable. If for my client, they run all reimbursements through Payroll, so we enter it, there's a taxable earning code for that reimbursement, and it's in our reimbursement policy that we offer same-day travel reimbursement, however, it is a taxable fringe benefit, so it shows up in their gross wages. Whereas a taxable fringe benefit that you gave outside of payroll would just be an in and out, so that it would get taxed. So. Any other questions?